Welcome to the Common Sense Investing, or CSI Show, with Victor McClure and Guy Allard from McClure Capital Wealth Management Companies. Victor and Guy will use their combined 60-plus years of experience to answer your financial questions with their own brand of plain-spoken language and hard-hitting style.
Welcome to the show. Happy New Year again. It's our second show of the year. I'm Victor McClure.
I'm Guy Allard.
Today we're going to start where we finished last time, where we left off. How about that? We talked about the 5 personalities for investing personalities. If you can recognize which investing personality you are, you can avoid some things and look deeper in other things. But that's what we're going to talk about today, is the 5 investing personalities.
Being self-analytical, though, has proven difficult for many. It's much easier to see somebody else's flaws than your own. Yes?
Right. Well, like I said, we talked about this before. If you're the world is so dang political right now that if you're in one camp or the other, you only listen to the news from that camp. Everything else from the other camp is obviously not news. It's
self-indicating. That's right. That's right.
You find something that reinforces opinions you already had.
He's a smart guy.
That's right.
He agrees with me. That's right.
And people,
I like him.
That's where they look. You know, the same thing in investing. People are might have a herd mentality. It's always been like that. What do you think? Bitcoin's been around since 2009. Why is Bitcoin in the news every day for the last 6 months? Because it just became popular. About it one thing.
I got to tell you, I haven't checked on that all week. You have any clue where it's at?
Yeah, like 13,000, something like that.
Is it settling in?
Yeah, it's settling in.
Sort of.
But remember, if you'd like to take advantage of any of our no-cost, no-obligation offers we have here, like a written retirement plan. If you're with an advisor right now or don't have an advisor, and you don't have a written retirement plan. Now, a written retirement plan is not showing you if you make 10% a year for the rest of your life that you'll be fine. A written retirement plan is showing you, what your life would be like if this happened, if this occurred. If the market didn't cooperate, does that mean you're eating cat food when you're 80? All of those things. This shows rising healthcare costs. Right now you have a certain amount of bills. But I promise you, your groceries will not be the same price 20 years from now. Neither will your healthcare costs or anything else.
And I'll mention this. Looking for an advisor in some aspects when you're talking about rates is truly, and hear me out, truly counterintuitive. When you buy a car, you want to get the most car for the money. When you buy a house, you want the lowest rate. You want the lowest price for the same product. In the financial world, if you strictly shop yield and shop rates, it's very difficult to truly do. We talked a little bit last week about how much the stock market, S&P 500, we use because it's 500 stocks instead of 30 or 40, since 2000 is bumped up now to 5.17%. So if someone is showing you, whether it's a life insurance example we'll get into later, or returns on their managed money that's significantly higher than that, you have to question it. You can't just automatically jump with the one that's offering you the highest average rate of return, because there's a reason. Either it hasn't been around long enough to fade a market correction, or they're using higher than normal averages. I mean, you really have to look at it. It's not just, he's got the highest rate, I need to go with him. So be careful if you're shopping strictly by return.
The most common thing I see in there is they just manipulate the dates.
That's right. Yes.
They'll say April of 1997 till September of they're manipulating the rates because that was a particularly good period if you take it by the month.
Yeah, you go after the last crash. Go sometime in 2009 through the end of 2017. Everyone's done really well.
That's the only thing you could compare to make apples to apples is actual years, calendar years.
Correct.
Remember that.
Minus fees, costs.
You see an illustration that's in between the years somehow, it's for a reason typically. Remember, you need a written retirement plan. You need a financial advisor that has your interests, has to put your interests ahead of theirs. Because
they shine light on the weaknesses and what you're going to face and the hurdles that are upcoming.
Our number is 972-715-2424. Again, 972-715-2424. Or you can always go to our website at ilovemyretirement.com. All right, let's talk about the 5 financial personalities. The first one is the seeker. Okay, now I have an accent, so this is going to get in here. We already. So the seeker is a generous, optimistic, and spontaneous investor. The seeker experiments to find the best approach to financial planning. The seeker understands saving is important but lacks attention to detail and finds new information distracting. expert seekers to look for an exit. They look for an exit if you ask them to review financial plans details, not the detail people. Okay, sometimes you'll find a lot of people in sales jobs and stuff like this. They're not the best detail. They're great personality people, not the best detail people. Here's the second one. The believer. The believer generally is financially optimistic. To the believer, purpose of money is to make life enjoyable. The believer is typically generous and creative. However, the believer also has trouble grasping how today's small actions can lead to tomorrow's rewards. That can you get
More of an instant gratification.
Yeah, they're just like I said. They believe things.
Yep.
They just don't know how when you change something in a plan, how that can affect you long term because they're thinking about today. They're the ones thinking, I'm going to live for today. I've got friends that are very good savers, but they haven't had the greatest. They haven't enjoyed life all the way till then, but they'll have a great retirement. Then you have other people that have lived the life, had every kind of car, every kind of house, blah, 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 but their retirement's going to be relaxing. So you got to somewhere in between, right? The warrior, not warrior like a worry. They worry, okay?
A worrier.
All right. The warrior is a personality of investor, is cautious about finances, always on the lookout for potential problems. In other words, they're not looking for the best return. They're always looking for what's worst that can happen. And remember, a lot of people are a combination of these different traits. But like right now, you're not getting it. The warriors have kind of gone to the background. The warriors, the people that worry. Now the optimistic people are all out because the market's got up 9 years in a row.
That's right.
And what happens is,
and they're not worrying as much.
When you do a personality test for someone, you're trying to be a fiduciary for a client, and they'll say something like, "Well, I want 20% returns." What's the worst thing that can happen? Well, losing $1. They're not aggressive. They're actually conservative. They just want a great return because the worst thing that can happen to them is losing money.
Everyone wants to be high on the return and low on the risk.
That's right. But tracking money for the worrier is usually stressful. To the point the warrior avoids it. The warrior is risk averse and become agitated when it comes to investing.
Yeah.
So are you the seeker, the believer, or the warrior? All right, what's the next one? The tracker.
And we often call worriers terrorists because they're the ones that have usually a small amount of money and they call you all the time. What's it doing? What's it doing? What's it doing?
Well, that brings us to the next personality trait of investor, the tracker.
Tracker.
I have more of these than anybody I know, any financial advisor I know.
Engineers.
A lot of engineers. They're deeply aware of his or her finances. The tracker knows how much is in their retirement account, in their savings account, even in their piggy bank. Splurging is not part of the tracker's vocabulary. In fact, the tracker is the opposite. Spending money on even a necessity can make a tracker cringe. And that's what we talked about, like I said, my friends before. Great savers, they don't care if they live in a one-bedroom trailer because they'll never have to work. And they still worry about it. Right. They still worry about somehow they're going to be on the street, even though they know logically they cannot.
And it used to be the Depression babies, right? That were doing that, but our generation certainly wasn't.
I mean, when the market's doing bad, you'll find a lot of people a combination of warriors and trackers, because everybody goes back to the shell. When the market's going, everybody's, oh no, I'm definitely a risk taker. Yep. Make 20.
Flight to quality.
That's right. The last type, number 5 type of personality, is called the planner. When it comes to finances, the planner is confident and optimistic. The planner understands money is a means to enjoying life, but investing also is necessary to ensuring a bright future. Planners are clear about their needs and wants, and they value planning to create a strong financial future. That's the ones we want, all those.
I like planners.
We always want that.
Logical, looking at the numbers. That's right. Thorough.
Right. I do everything, and we do everything here at McClure Capital based on math. Everything is mathematics. Because I'm telling you, if you're getting some sales pitch, they're going to highlight the highs and lowlight the lows. If they tell you anything about the lows or the negatives, right? If you get anything at all, it's going to be, oh, yeah, but that's so unlikely. This is 99% good. The 1%, oh, my gosh. It's almost like Mars slapping into the Earth.
I don't mind 99 to 1. That's not bad. But it's usually much worse than that.
That's right. Usually, like I said, we go by the numbers only because math never lies. Math is what it is.
And we're positive people. You got to get in the right mindset. The old saying, and is accurate, is you plan for the worst But you expect the best. We always expect the best. But we're safe because we planned for the worst.
I'll give you my personal count made 20-something% last year, just like a lot of you out there. Does that mean I'm not going to plan? No, you still have to plan.
And
that makes it more.
Did you have every cent in that account in the market?
No, but that's what you have to do. Is you have to look at these things, even though
hindsight, you'd like to have.
I think the psychological power of missing out is the greatest thing. Yeah. It's strong in people. Ooh, I just can't stand missing out. That's why even if you think about it, the market's gone up 9 years in a row. It's never gone up, or 8 years in a row. It's never gone up 8 years in history. The market's twice the valuation it should be according to the PE ratio. Any of the forward-looking PEs, any of them. So that would lead you to believe, logically, well, I need to take some off the table. But that power of missing out. I think it's going to go for another year or two.
Unemployment's going down and earnings are coming up. But think about human nature. This is switch gears on you a little bit. We've done several shows over the years on the psychology of investing and just what's normal human nature, even for the most positive. Let's say you've got 50% in a low yield bond because you're safe, and you got 50% in the market. This year, your market money made 20%, and you really wish that you didn't have so much in bonds. In 2008, when the market went down 30% and you lost 30% of your market account, you really wish that you would have been smarter and had more money in the safe side, don't you? But you plan, you adjust as you get old. As Victor was saying, you rebalance your portfolio, which we laugh, but you sell the winners and buy some more of the safer stuff or the losers. So that you have to do that for everything to work for your retirement.
Well, I'm telling you right now, the market lost 50% in 2008, right? Or actually, it was late 2007 to early 2009.
How about the NASDAQ in 2000?
It was 55%.
Wow, yeah.
And then you go back to 2000, and they lost like 75%.
Oh.
If you would have been reallocating.
And everyone got there because it hurt. It was doing so well.
If you'd have been reallocating what you should have been doing, like take it out of the winter and put it in the other ones, you wouldn't have lost anywhere close. You would have recovered twice as fast.
That's right.
But it is the hardest thing for a human being to do is to take some money out of a winner. It's like I said, even though it's they'll logically understand. I have some very intelligent doctors, engineers, and they said, no, I just think it's going to go for another year. I go, what? He goes, oh, it's just a feeling. It's really not. It's a feeling of greed, and it's a feeling that I know I don't want to miss out on this piece. I talked to one the other day. I said, we're just talking about 20% off to guarantee your future. That's only 1 year worth of returns. You can keep the other 7 years and whatever future.
That's right.
And they're like, oh, I'm going to do it, but I'm going to wait a year.
That's right.
Everybody, and like I said.
And then when the market goes down 30%, I got to wait for it to come back.
That's right. What is your worst thing in the world when it comes to investing? Your emotions.
Yeah.
Because that's the one. Because what it does, it locks you in. Your emotions lock you in. Let's say the market's going up. Well, I'm not selling a winner. Are you stupid? Then if it goes down, well, I can't sell it now. I got to break even.
That's right.
You can't sell and you can't buy. You're locked into this roller coaster forever. So you got to break away from emotions. Think about if you were gambling in Vegas. I was in Vegas. My mother was ill here last week. I hate gambling, right?
We play poker every now and then, but we don't.
Yeah, that's entertainment.
Yeah, just
got a couple $100 entertainment.
That's right.
But think about, would it make logical sense if you're on a big win streak in the poker deal? All right, take a little bit off the top. All right, now I'm working on their house money, right? Take a little bit off every time you win or whatever. Now, that's what people that would end up with all the money.
So much so that they have a table rule. Mm-hmm. And I forget the term. You probably know it because you guys own some of that in California. But you're not supposed to take money off the table and put it in your pocket until you leave. They have a term for it?
I can't remember now.
But it's a rule kind of, right? Yeah. It's an
sometimes
unwritten rule. Whatever you have on the table, they don't allow you to take it and put it in your pocket.
They do it on purpose because they know you'll give it back 90% of the time.
That's right. That's right.
But you've got to really think about that. Does that make – of course it does. If you could take off 1 year's worth of gain out of 8, and guarantee your future, that doesn't make sense because you're afraid of missing out on just that piece. Remember, 80%, 90% of your money is still going to be making that return. But even that is really difficult to pull the trigger. It takes strength, and it takes someone to get away from emotion just for a second and think only logic. And taking 1 year's worth of returns to guarantee your future is nothing to ask. But you got to really look at that. Remember, call us at 972-715-2424. We'll be more than happy to answer any of your financial questions. We could, like I said, you can take advantage of our written retirement plan, Social Security Optimizer. Again, 972-715-2424, or you can go to ilovemyretirement.com.
And what that Social Security Optimizer and the financial analysis, the stress test on your portfolio, the financial plans, what all that does for you is it gives you a tangible. It gives you the number. What does it take to make you happy? Why are we working? Why do we save money in our 401ks? What are we trying? What's the purpose of that money? What are we trying to do? We want to make sure that we can have a comfortable retirement. Do you know what that number is? These things show that. They show you your Social Security, what it's going to, not your Social Security, your income tax, what it's going to be each year through your retirement. It breaks it all down. If you don't know that monthly number, you'll never get there. If you know what that monthly number is, you might be shocked. What if 20% would get you what you need? What if 40% of what you've already got saved in your retirement will get you what you need, take care of any future inflation, and give you plenty of extra cash? You may have already won the race, but you've got to know what the number is.
And remember that our software has been updated for the new tax law.
That's right.
From 2 weeks ago. So we can give you anything. We can do that. There's no cost, no obligation. Again, 972-715-2424. Or you can always go to our website, ilovemyretirement.com. All right. We talked a little bit about personalities, the seeker, the believer, the warrior, tracker, and the planner. Different types of investing traits or personalities. We're going to talk about something right now that I think it's an investment strategy that kind of takes all of those strategies. It has something for each type of investment personality. Let me give you an example. What if the market, you could get the first 13.5% of the S&P 500? Index itself, they have no control. First 13.5%, but you're guaranteed not to take a down year ever. The result has been the last 20 years, you'd have got like 8.5% return. Not too bad. The market wasn't even close.
That's right.
Remember, for 18 years, it was 5%. If you go two more, you're going to have two more up years. It's going to be maybe 6.5. So you beat the market during this period just because you cannot take a down year, and you're going to get the first 13 of up years. On top of that, it does a couple other things. Let's say you could get long-term. If you went to a nursing home or had a nurse come to your home, it covers that. Okay. Let's say you needed something to go to your heirs in case you died. You were a younger person. You needed something. He does that. What if you were trying to figure out a way to retire, but worried about taxes? Takes care of that. And so there's so many different things. What if you're worried about market risk? Takes care of that. There's all kinds of things that you worry about in the future. But sometimes you can do it. And what I'm talking about now is an index universal life policy.
And I'll add in, I don't know exactly where you're going. Hopefully I'm not preempting you down the road. But it sounds too good to be true, right? It does all these marvelous things. It takes care of things. There's got to be a catch, right? There is.
That's right.
You've got to be a planner. You've got to do, the younger you are when you do this, because of the time value of money, the way better off you are down the road. If as you get older, it gets too expensive. You get
it works into
high
your
cholesterol,
mid to late 60s, but you're stretching it. It works really good 30s, 40s, and 50s.
Real good 30s and 40s.
Yeah. So that's why you look at this thing. But if you've heard my show for the last 20 years, I'm not a big life insurance fan. Never have been.
We don't talk about it much.
Because I don't like it. Because it's expensive. And some of the life insurance sales guys are a little bit creepy to me. I mean, I'm just saying.
We talked about it when we went through the 5 different personalities, and that was, we talked about when you're shopping for an advisor, it's not always the rate of return he promises you, and you've got to look at the time periods and all of that. Most life guys, when they give you these type of proposals, use very high rates. Well, if the market averages 8 or 9% per year, in 30 years you'll be able to get this much tax-free income. And then we come along and try to be conservative, right, and show a realistic number, 5%, 5.5%, 6%, and you see our proposal, and you see the guy that offered you 9%. Well, what makes it? I want the bigger number. So right, you have to
and
really
be careful.
Same
product.
Yeah, same product, same thing.
All they did is illustrate it higher to show you a bigger number.
That's right.
It's just like when that's why I was talking to a realtor yesterday, and the realtor goes, "It's not really unfair what you have here when somebody listing your house. Just one guy cannot deliver that price.
Right.
But they got 3 realtors that are going to take the higher price every time, even though they'll never sell that house.
That's right.
By the time he drops it down and you're on the market now for 6 months instead of 1 month.
People are wondering what's wrong with the house.
That's right. But they got to play that game anyway. So that's why I'm saying with this. Now, what this is, remember, you get the first 13.5 of the S&P, no down years guaranteed. What that return over 5 years, it was 8.7% average. Over 10 years, 7.7% average. Over 20 years, 7.8. 25 years, 8. 30 years, 8.1. 40 years, 6, 7.9. 7.49. We illustrated, 6.5 on his? Lower than any of these averages.
Yes.
We illustrated 6.5.
This was actually I see you.
Yeah.
A proposal that we did for a potential client of mine, or a son of a potential client of mine.
Let me show you what this person was going to put $500,000 a year for 5 years into this policy.
38 years old.
Yep. What it did is it gave him $14 million. If anything happened to him, $14 million tax free. Okay, so $2,514 million. Now I've also done it for $100,000. Let's say $100,000 for 5 years. We give him $2.8 million to your heirs. Not bad, right? You put it in for 5 years. Okay. This is for retirement. So when he was 60, he's almost 40 now. So when he's 60, you put in $500,000 times 5 years. You're going to get $546,000 tax free for the next 30 years. So you put in for 5.
Yep.
You're going to get 30 years of more than that number tax free, and your heirs are going to receive a death benefit. So let's say you've been in it. You're 68 years old. You slip and break your neck. Well, you've been paid out. You paid in $2.5 million. You've already got $4.3 million tax free, and your heirs get another $9 million tax free.
We also did an example for a friend of ours at like $50,000 a year, didn't we?
Yeah, we've done.
And it still worked out really good for him.
Remember, if let's say he lived at 78 years old, well, he'd received $9.8 million in tax-free payments, tax-free income payments. Remember, he only put in $2.5 million.
That's right.
Now he's got $9.8 million in tax-free payments, plus his heirs still get $5 million tax-free. All right. Same thing. It goes down to where you can get it where, let's say that he lived a really long life, till 90 or whatever. Well, he received on the $2.5 million he put in $15 million in payments, and his heirs still got another $5 million.
And all this money is tax-free.
That's right. That's $20 million tax-free on 2. Now, if you do it for $100,000, remember 100 for 5 years is $500,000. You just still got $3 million in tax-free payments. Think about that. I'm going to turn $100,000 for 5 years, so into 30 years of $100,000 a year tax-free, 109, tax-free for 30 years. So no matter what, I'm getting payments of $3 million. My heirs are still going to get another $1 million, $2 million. So you're getting $3 to $4 million when you put in $500,000, and that's all tax-free. Now let's say you're 80 years old, this is going fine, you got to go to a nursing home, or a nurse has to come to your home. It will pay you $24,000 per month while you're in that nursing home. Comes out of your death benefit. So $24,000 a month. Now it works. Here's a catch. Let's say I did $100,000. You're not going to get your payments only going to be $100,000 a year for 30 years, right? You're not going to get $500,000.
Right.
But you're getting the same $24,000 a month to cover long-term care. So think of what you've got. You've covered taxation because you're turning an asset into 10 times what you've put in, tax-free, plus another tax-free lump sum to your heirs. You covered running out of money. Because remember, you put in $100,000 for 5 years, you're going to get $100,000 tax-free for life, almost, for 30 years. $500,000 get you $500,000 tax-free.
That's right.
Those are huge numbers. You participate in market index. So if the market goes up, you get up to 13.5% of the return. The market goes down, you just get 0 that year. Okay? When the average has been at least 7-8% forever. You eliminate market risk because you have no loss potential. I don't care if the market drops 50%. 2 years in a row. I understand there's no way to get to 0. You'd be 25%.
That's right.
But no matter what, you cannot lose a penny. All right? As soon as it starts going up, you get to gain again. Covers long-term care. There's so many things out. Long-term care insurance used to be really cheap. $100 gets you for a lifetime. Now it's $500 a month for 4 years, 3 years. It's ridiculous now. Why not get it for something like this? If you don't use it, it just goes to your heirs. It goes in your bank account. But it's going to pay you if you have $1 million death benefit, it takes about $80,000 a year, $70,000 a year for this particular person. You're going to get $24,000 a month to cover long-term care. Now you can have a pretty dang good nurse or a group of them for $24,000 a month.
And I would almost challenge anybody out there that could find the equivalent of this or close.
Well, think about it. You just got to put it. I don't like the way it's called. Like I said, I've never been a life insurance guy, but Index Universal Life has changed the game in some ways. Because like in Universal Life, they pay you a dividend based on the company profits. And they can determine whatever that is. Whole life, same thing.
That's
well, I think we're 5% this year. You know, this year it's 1%. I don't care if they made a fortune. They can still say it's whatever it is, right? This they have no control over. They got a little control on the caps, but not much. I'm going to get the first 13%, so I can make up to 13% a year on the thing and take no down years ever. All right, so I'm okay with that. But also, it covers if I'm a younger person and I pass away, I'm worried about my family, my kids going to college. It's going to give them several $1 million tax-free for that. So you're covering your retirement. You're covering your long-term care. You're covering the kids' college if something happens to you. You're covering so many things on this. Are they perfect? No. You know, there's cost involved in life insurance, right? If you're a big smoker and you're 500 pounds, you're going to pay more.
You got cholesterol problems. That's right.
So this is ideal for somebody, like I said, 30s, 40s, even in the 50s, but they're decently healthy. Because what happens is if you're a smoker, I don't care what it is, try to get insurance on a smoker. They rape you.
And trust me, the weight to height charts are way off. That's what I'm thinking.
Well, they told me, I looked at the chart, and I'm borderline obese because I'm 200 pounds, 5'10".
Right.
And they go, 5'10" should be about 160 pounds max. I was like, I weighed that much in the 9th grade. How could that be?
Same thing. I'm 6'2". You're supposed to weigh 190. Yeah. That was like my senior year in high school. I mean, I'm not seeing 190 again
I
ever.
have like a 27-inch waist. I mean, my one leg doesn't fit in there anymore.
That's right.
But so it's not perfect but if you are one of those people that are looking for a combination thing that can, like I said, cover your retirement, cover your taxes throughout your lifetime, get something to your heirs, eliminate market risk, but participate market. Cover a nursing home or a nurse coming to your home and allowing your heirs to get money in case you died early. One thing can cover a lot of different things, but they're not perfect. You got to be one of these people that are in decent shape. You can't have just come from cancer surgery. Nobody's going to insure you.
That's right.
Just like your house is burning down, you see smoke. You say, I'd like an insurance policy, please. Can I buy one? I didn't have one before, but I think I need one now. Right. They're not going to insure you when your house is burning down. But if you can have those different things, I'm telling you, for a younger person, it takes so much less. To get $100,000 a year, think about it right now, the 4% rule. You need $2.5 million. We got $100,000 a year tax-free on $100,000 5 years. So $500,000 could get it. So if you wait till you're older, it's going to take several $1 million to reproduce the same amount this will tax-free.
And the numbers aren't exact, but, or 50 for 10 years, there's different combinations thereof. And that's what we're here for.
Right. But that's why sometimes just look at an illustration. Sometimes it fits you, sometimes it doesn't. I've had people come in and they're like, well, I've run the illustration. It's terrible. Don't look at it. Now let's look at other things. Right. And I've run other people and I'm telling you, if I was a 40-year-old and I had a little bit of cash, I would put some in something like that because it's going to cover a lot of things. Don't get me wrong. At 40 years old, I'm still in the market. There's nothing wrong with the stock market. Anybody tells you there's something wrong with the stock market is lying and they're trying to say something else. Nothing wrong. I'm in the stock market. I'm in my mid-50s. There's nothing wrong with the stock market. But if I can reallocate a portion of those funds and guarantee my long-term care, my life, everything, tax-free payments forever, I'm going to look at it. Our number is 972-715-2424. Again, 972-715-2424. You always go to our website. We got some new videos on there. I think there's some white papers. They change those out about once a month at ilovemyretirement.com. Very easy to remember, ilovemyretirement.com. Again, our number 972-715-2424. Well, I'm Victor. Thanks a lot for listening. I'm Victor McClure. For Guy Allert, we always appreciate your time.
The preceding show is paid for by McClure Capital and is for informational purposes only and not a solicitation or representation of any particular investment product or service. Any views and opinions do not constitute financial, legal, or tax advice. Consult with your appropriate professionals before making any investment or savings decisions. Always consider your risk tolerance, time horizon, and objectives in making any financial decisions. There is never any guarantee of future success or performance.